Today we'll be talking about high probability fair value gaps and how to spot them. So, this isn't very good. So by now you already know what a fair value gap is, but the problem most times is being able to identify the ones that are high probability and the ones that probably would not be playing out. So in this video that's what I'll be showing you. So first, a quick recap: of fair value gap is an imbalance in the market that forms a strong price movement like this. We have a fair value gap here. Let's draw it out. We have a fair value gap here next to the top of that candle. You all know how to draw a fair value gap. If you don't, then you go check the video for fair value gap, because this one is to identify high probability fair value gaps. And then we have another one here, but it's been tested already. So we have this one, right? Here at this point, we had from that candle down to this one. We had one here, like I said, but it's been tested. So right now, there's no fair value gap anymore at that point because it's been tested. But there was one before this candle, and then this candle came in, and this one broke through it, right? So now, the first thing we're going to be looking for while looking out for a high probability fair value gap is a displacement. What's the displacement? Is having engulfing candles of whatever bearish or bullish, depending on what direction it came from, having engulfing candles, which is big candles like this, showing big price movement from this point to this point, right? That's what the displacement would be. But what makes a displacement more valid is having a break of structure by the side. So we have like a support by at the opposite side here, and then there's one here, which automatically makes it a perfect displacement. So if that displacement, obviously 90% of the time, not even 90, 100% of the time, a displacement is always a fair value gap, right? But across a break of structure, that fair value gap that happens where structure gets broken, that point is usually a high displacement area, right? So if price should try to break a structure and then create an engulfing candle like this, it's a displacement candle. This is more, we would just identify this as a fair value gap or an engulfing candle. But when we have it sitting at this point, there's a support here, and then it comes across it. That's a displacement candle, and a very strong one like that. Compared to when you also have, can you see at this point, you also have a displacement here, and then there's a resistance at this point, and then price breaks it. You can see price pulls in, tests the resistance, and also the fair value gap. So that's really how, if you want to look for high probability fair value gap, you look for the ones that are across a resistance or a support, which makes it a displacement candle. So every displacement candle is always always has a fair value gap, but the ones that make it more high probability is the ones sitting across a support or a resistance, right? This is a resistance sitting across it, this is a support sitting across it, and all those points are just very high probability. 90% of times price will always get to that level, test those ones, and then continue whichever direction it chooses to go. So you have to look out for these things. And then secondly, the market structure. I already talked about displacement. The market structure, you also have to look at your trend. What's pushing price towards this? Price has to only go back and create higher highs, higher lows, right? And the displacement point, because fair value gaps are sitting across the previous support or resistance that was created, which means you have to look at the structuring. So every time for an uptrend, it has to create the higher highs, the higher lows, and then across it has to be the fair value gap that makes it a displacement. Price pull back into your fair value gap, that makes it a very high probability fair value gap that can be used to catch the trade, right? That's two. And then thirdly sorry, and then thirdly we have where it's located at, and the fact that it's untested, and the higher time frame also. So this is a 1 hour time frame, that's good enough. 4 hours too, that's good enough. These are areas where you should look at very much. You can always go down to another time frame, maybe your 30 minutes for entry purposes, but your 1 hour, your 4 hours, these are very valid points to find things like that, and they have high probability. And then you also know that liquidity is sitting around that area, and what I tell you guys liquidity is literally just the point where you automatically to yourself believe that people trades or orders were executed in large numbers at that level. So right now, everybody will be looking. Oh, if we have a displacement across this, right? Everybody's looking for price to come back in, which means around here there are lots of liquidity sitting. There are lots of traders sitting at that point. You also take that as so people that will trade breakout, which already means that there's a resistance here. This displacement was the breakout, and that's why we actually have a displacement. You already know that there are lots of people that are sitting at that point. People that trade breakouts, people that have gone to the lower time frame and look for one thing or the other. There are lots of people that would have been sitting, and that's why the displacement was created. So every time you see displacement, especially across a resistance or a support, which created a fair value gap, which a fair value gap is the imbalance in the market, you always know there are lots of liquidity sitting at that point. So it's enough for you to know to pairing together the fair value gap, the fact that it's a displacement, and identifying the market structure together will actually help you identify high probability fair value gaps and help you give you an edge around it, because there are people that most of the time all the trade are fair value gaps. So this is enough to actually make you understand how to get these points right. Now another thing you need to understand is what makes a fair value gap weaker. So you have to be cautious in choppy markets, because sometimes they might create a very meaningless displacement, and you might end up just so it has to be a trendy market for you to actually use that as a high probability fair value gap, right? So, and a common mistake most people make is trading every fair value gap. That's why I said you have to pair it with your structuring. You can't just trade every fair value gap. Is why it has to be a displacement across the support or a resistance. And when you know you feel those areas, you know there's about to be a change of character. And then you ignore the context, you ignore the um, risk. You enter too early. Regardless of all of this, you have to go to a lower time frame and look for confirmations, right? But still, you already know that once price got to this level, it was valid enough, right? But still, you need to go to a lower time frame and look for confirmations. I'm not here to tell you how to. I'm only here to tell you how to spot your high probability fair value cash, because this is not a financial advice. So do well with it. So you cannot trade every fair value gap. The question you need to ask is, why did this fair value gap form? Where did it from? And what did price accomplish when it got formed, right? You can't just go around trading every fair value gap. So a fair value gap itself doesn't mean a trade. The surrounding market tells you whether the fair value gap is worth paying attention to or not. So in the next lesson, we'll go further more into discussing something equally important, and that when should you ignore a fair value gap. For now, this is all that it has to do with understanding high probability fair value gaps. Don't forget to like, share, and subscribe. And if you have questions, put them in the comment section. I'll be more than glad to respond. Do have a nice day.